The head of the Distilled Spirits Council of the United States went on television and made what sounded like a simple, logical argument. Canada is losing approximately $500 million Canadian dollars in provincial revenue by keeping American spirits off its shelves. Restore the bourbon, restore the revenue. The economic pain disappears for both sides. Within hours, analysts in Canada began examining that number, and what they found was not a different estimate of the same figure. What they found was that the $500 million was the wrong number entirely, not because it was inaccurate about what it measured, but because what it measured was the smallest part of the actual economic picture. A number chosen, intentionally or not, that directed attention toward Canadian losses while the far larger consequences were developing on the American side of the border. Here is what was not in the interview. 45 million unsold cases of bourbon and whiskey sitting in Kentucky warehouses. Inventory worth an estimated $3.8 billion with no immediate destination. A 72% drop in cross-border alcohol freight that has erased more than $600 million in annual transportation contracts. Barrel manufacturers reporting new orders down 40%. Glass bottle suppliers cutting production schedules by a third. Packaging facilities warning of layoffs. An industry briefing to investors projecting losses approaching $1.7 billion in export revenue if the trade war continues through year-end. Combined market value of publicly traded American beverage companies fluctuating by more than $9 billion over 3 weeks as analysts downgraded North American export projections. And beneath all of that, the detail that changes the frame entirely, Canadian alcohol retail revenue remained within 2% of the previous year's levels, even after thousands of American products disappeared from shelves. The Canadian market did not collapse, it redirected. Within 6 months, nearly 85% of the revenue once generated by American alcohol was replaced by domestic Canadian brands, Scottish whiskey, Irish whiskey, and Japanese spirits. The money stayed in Canadian stores, it just stopped going to American producers. The gaslighting accusation is not that the $500 million figure was fabricated, it is that presenting Canada's provincial revenue loss as the central economic consequence of the boycott, while the American industry was sitting on $3.8 billion in stranded inventory, was a framing decision that described the wrong side's problem as the story. Welcome back. Today we go through the full economic picture that the interview obscured. The American industry's actual exposure, what happened inside Canada's alcohol market, the tourism and investment shifts that extend far beyond spirits, and the number that puts all of it in context. If Canadian importers redirected just 5% of their annual purchases away from the United States, the resulting $21 billion in lost export demand would be more than 20 times larger than the total value of American alcohol exports to Canada before the boycott began. Let's go. To understand how the framing worked, you have to understand the structure of the boycott and what it actually produced on both sides. When Canadian provinces began removing American spirits from provincial liquor store shelves in response to tariffs on Canadian goods, the stated Canadian concern was economic leverage, using consumer behavior to impose costs on American exporters that would create political pressure for tariff reversal. The American industry's response was to argue that the boycott was self-defeating. Canada was hurting its own provincial revenues, and the rational path was restoration of American products. That argument had intuitive appeal. Provincial liquor authorities in Canada collect significant revenue from alcohol sales. If American products disappear and Canadian consumers stop buying alcohol, the provinces lose money. The $500 million figure was the estimate of that provincial revenue loss, and it was presented as evidence that the boycott was economically irrational for Canada. The problem with the argument is the conditional it contains. If Canadian consumers stop buying alcohol, that did not happen. Canadian consumers did not stop buying alcohol. They bought different alcohol, and the transition happened faster and more completely than anyone in the American industry had predicted. Within the first 2 months of 2026, provincial liquor authorities reported that sales of domestically produced Canadian spirits increased by more than 23% nationwide. For smaller craft distilleries that had struggled for years to compete with heavily marketed American bourbon brands, the change was transformative. Industry surveys indicated some producers saw revenue growth exceeding 150% compared with the prior year. In British Columbia and Alberta, mid-sized distilleries reported operating at nearly 90% production capacity, levels they had never reached before. International suppliers moved immediately to fill the remaining gap. Scotch whiskey imports rose by roughly 41%. Irish whiskey imports climbed nearly 33%. Premium Japanese spirits saw Canadian sales growth exceeding 70% in certain brands. The transition from American products to alternatives was not gradual. It was rapid, comprehensive, and, critically for the long-term analysis, self-reinforcing. Once Canadian consumers found alternatives and liked them, the behavioral change did not require the boycott to be formally maintained. It became consumer preference. Total alcohol imports into Canada fell by only 9% overall. The other 91% of the market was captured by producers who were not American. Nearly all the American market share loss went to Canadian producers and international competitors, not to reduced consumption. The provincial revenue loss was real, but limited precisely because consumption did not fall. The $500 million estimate of revenue loss was a real number about a real phenomenon, but it described Canada's minor adjustment while the American industry was managing a catastrophic supply collapse with nowhere to send $3.8 billion in inventory. Now the inventory crisis, because this is the dimension of the story that received almost no coverage. Kentucky warehouses are holding an estimated 45 million unsold cases of bourbon and whiskey. The scale of that number requires context. The American spirits industry expanded aggressively over the past decade as bourbon experienced a global demand surge. New distilleries opened, aging barrel production increased, and supply chains scaled on the assumption that export demand would continue growing. Canada was the #1 export market for American wine before the boycott and one of the largest markets for American spirits. The supply chains were built with Canadian market access as a load-bearing assumption. When that market access collapsed by 68% in a single year, the inventory had nowhere to go. Bourbon cannot be quickly converted to other products. It has to age. The aging barrels sitting in Kentucky represent years of production investment that was priced against anticipated export revenue that is no longer arriving. Credit agencies monitoring the sector warned that distilleries which expanded aggressively could face serious debt pressure if international shipments continue shrinking. Companies that borrowed to expand capacity against projected export demand are now servicing that debt with contracted revenue. The transportation sector absorbed the first wave of impact. Cross-border alcohol freight fell 72%, erasing more than $600 million in annual transportation contracts. Barrel manufacturers saw new orders fall 40%. Glass bottle suppliers cut production schedules by a third. Packaging facilities warned of layoffs. These are not companies visible in the public debate about the boycott. They are the industrial ecosystem surrounding the spirits industry. Suppliers, manufacturers, logistics operators whose businesses depend on the export volume that the Canadian market represented. The $1.7 billion in projected annual export revenue loss if the trade war continues through year-end is not a worst-case scenario. It is the industry's own projection distributed to investors as a planning baseline. Now tourism, because the alcohol boycott is the visible symptom of a shift in Canadian consumer sentiment that extends far beyond what Canadians drink. Canadian visitors historically contributed more than 20 million trips per year to the American economy. Those trips supported hotels, restaurants, casinos, shopping malls, and thousands of small businesses in northern states. New travel data from the first half of 2026 showed bookings by Canadian tourists to the United States falling 30 to 38% compared with the same period a year earlier. Economists estimate the reduction could remove approximately $7.2 billion in annual visitor spending from American tourism sectors. The impact is concentrated in states that depend most heavily on Canadian visitors. Retail groups in New York, Michigan, and Washington reported weekend shopping traffic from Canada, declining by as much as 40% to 45% in border communities. Hotels that once filled with Canadian families during school holidays are reporting noticeable booking reductions. Restaurants that relied on cross-border diners are absorbing lower weekly revenues. For local economies in border towns, the shift is not abstract. It is visible in foot traffic, table counts, and weekend receipts. The $7.2 billion in reduced visitor spending is more than 12 times the $500 million in provincial revenue loss that the American industry official presented as Canada's economic problem. That inversion, the American tourism sector losing 12 times what Canadian provinces lost in alcohol revenue, is the structural relationship the framing concealed. Now investment flows, because this is the dimension that operates most quietly and carries the longest-term consequences. Canadian institutional investors, pension funds and asset managers managing the retirement savings of millions of Canadians, quietly began reducing exposure to American consumer industries linked to tourism and retail spending. Financial disclosures indicated Canadian funds redirected more than $15 billion in portfolio assets toward domestic and European markets during the first half of the year. The reallocation was not announced as a political statement. It was executed as a risk management decision. Fund managers assessed that cross-border consumer sentiment was shifting and reduced exposure to the sectors most vulnerable to that shift. $15 billion in portfolio reallocation is not visible to consumers. It does not appear on a gas station receipt or a grocery bill. It appears in quarterly earnings reports when companies that depend on Canadian visitor spending or Canadian market access report lower revenues and analysts trace the shortfall to reduced Canadian engagement. It appears in credit assessments when lenders price in the risk of sustained reduction in Canadian market access for American companies that depend on it. Now the number that reframes everything, because it puts the $500 million alcohol argument in its actual context. Canada imports more than $430 billion in goods from the United States annually. That makes Canada the largest single national market for American exports, larger than any other country's purchases from the United States. The scale of that relationship means that consumer sentiment shifts in Canada translate into American economic consequences at a ratio that no individual industry dispute captures. If Canadian importers redirected just 5% of their annual purchases away from American suppliers, to European alternatives, to Asian suppliers, to domestic Canadian production, the resulting loss in American export demand would exceed $21 billion. That number is more than 20 times the total value of American alcohol exports to Canada before the boycott began. It is 3 times the estimated tourism spending reduction. It is 40 times the provincial alcohol revenue loss that was presented as Canada's economic problem. The 5% scenario is not hypothetical. Canadian trade officials have accelerated negotiations with suppliers across Europe and Asia, seeking alternative sources for products that historically came from the United States. Trade analysts note that once supply contracts shift to new international partners, they tend to remain in place for years. The relationship building, the quality verification, the logistical infrastructure once established does not dissolve because the political dispute that motivated it eventually resolves. The alcohol market demonstrated this dynamic with unusual speed and clarity. Within 6 months, 85% of the American alcohol market share in Canada was captured by alternatives. The speed of that transition shocked observers who had assumed Canadian consumers were too brand loyal to American products to shift quickly. What the alcohol market proved is that deeply entrenched consumption habits can change faster than market assumptions predict when political conditions motivate consumers to seek alternatives, and alternatives are readily available. The lesson applies to every other category of American goods that Canada imports. The gaslighting accusation in its full context is not about whether the $500 million figure was accurate. It is about what the choice to present that figure as the central economic consequence of the boycott implied about the relative scale of costs on each side. When the head of the American spirits industry goes on television and frames the boycott as a Canadian self-inflicted wound measured in $500 million of provincial revenue loss, while sitting on $3.8 billion of stranded inventory, and while the American tourism sector is absorbing $7.2 billion in reduced Canadian visitor spending, the framing directs the audience toward the smallest number in the equation and away from the largest ones. Whether that direction is deliberate or simply reflects the natural tendency to advocate for one's industry, the effect is identical. The public debate focused on the wrong economic risk. Trade relationships are built on trust as well as economics. When one side of a deeply integrated economic partnership concludes that the public narrative surrounding a major dispute is being shaped to minimize their legitimate economic leverage and maximize pressure for their accommodation, when that perception solidifies, the trust erosion compounds the economic disruption. Canadian consumers who concluded that American industry was trying to manipulate rather than negotiate their position had additional motivation to maintain a boycott that might otherwise have faded as novelty wore off. The 73% of Canadians supporting the provincial bans as of late 2025 polling reflects both economic nationalism and the perception that accommodation is not reciprocated. Here is what you should be watching. Watch Kentucky bourbon warehouse inventory levels through the end of the year. If the 45 million case figure grows rather than shrinks, if Canadian market access does not recover and alternative export markets do not absorb the supply, the credit pressure on distilleries that expanded against projected demand becomes operationally visible in earnings reports and debt service disclosures. Watch cross-border tourism figures month over month. The 30 to 38% decline is the early measure. If it stabilizes, the behavioral shift may be temporary. If it deepens, the $7.2 billion estimate understates the long-term cost. Watch Canadian trade negotiation announcements with European and Asian suppliers. Each concluded alternative supply agreement is a reduction in the marginal share of the $430 billion annual market that flows to American exporters, and each concluded agreement creates the relationship infrastructure that persists beyond the current political moment. And watch the overall share of American goods in Canadian import data. The 5% scenario produces $21 billion in lost export demand. Early indicators suggest the directional shift is already underway. The speed and scale at which it progresses will determine whether this trade war produces a temporary market disruption or a permanent structural reorientation of the most important bilateral trade relationship in the world. The $500 million number was presented as Canada's problem. The $3.8 billion in stranded inventory, the $7.2 billion in reduced tourism spending, and the $21 billion potential in redirected import demand are America's problem. The framing that concealed that inversion is the gaslighting, and the market data that has been accumulating since is the correction.